Hi, Jim. How are you?
I'm fine, thanks. How are you, Dale?
Great to meet you, Jim. Stephen Sarge Guilfoyle wanted me to say hello to you, and your reputation precedes you in here. My associate Steve Volge and I agree that your book Currency War should be required reading for anyone who trades FX, and I think you could take it even out to any kind of trader or investor. Congratulations on forecasting this, and also 11 years, we're talking about it was published in 2011, so that was 7 years ago.
Well, thank you, Dale. That's very kind. What's interesting is you're right. The book came out in 2011, and one of the things I said then is that the world is not always in a currency war. It only happens at certain times, but when you are in a currency war, they can last for 10 or 15 or 20 years. And I gave several historical examples of that. So the fact that here we are in 2018, still in a currency war, still a topical subject, really doesn't surprise me. And I think we could be here 5 years from now still talking about it. I'm always, I don't know if amused is the right word, but it certainly catches my attention when I see a journalist. There'll be some development, some countries devaluing very explicitly to help their trading position or import inflation, and a reporter will say a currency war has started, and I say, well, no, it's the same currency war, it's just going on and will continue to go on for a long time.
You really coined that phrase, Jim. That's why everyone says it, because the race to the base is as old as time. Okay, I mean, you could go back to Rome and they took silver out of their coins while they were debasing. So here we are 7 years into it. I have a weekly dollar index chart in here. Is it more like trench warfare, where at times it looks like the dollar's losing the currency war when it's appreciating, and then since the election or last year, the dollar started coming down, so now it looks like it might be, possibly gaining some ground so we could export cheaper. And I have one question for you, Jim. It's probably an oxymoron, but is there any haven fiat currency that exists on the globe today?
Well, there isn't, and again, you make a very good point, Dale. The thing about currency wars is that they just go back and forth. They're inconclusive. One of the reasons they last so long is because the war's never over. It just goes on and on and on. It's like a ping pong match between two really strong opponents. They'll hit the ball back and forth for a long time. So first, you saw the currency war started in January 2010. The dollar hit an all-time low in August 2011. And then it got stronger from there. Lately, it's been going down again. And, maybe it's found its footing because of Fed tightening. But the point being, they just go back and forth. So if you look at the euro-US dollar cross rate, I remember in, 2011, 2012, you had Nouriel Roubini and Paul Krugman and Joe Stiglitz of Columbia running around with their hair on fire saying, the euro is collapsing, Greece is going to be kicked out, Spain should quit the euro, go back to the peseta, devalue the currency, lower the unit labor costs, there'll be a northern tier and a southern tier, etc. And I said, no, none of those things are going to happen. The euro is strong and getting stronger. It will add members, not lose them. And when I said that at the time, I said that they had 16 members. Today they have 19, getting ready to admit the 20th member. And I remember doing television interviews when the euro was around $1.03, and everyone was saying, "Well, it's going to parity."
Yeah.
To par. And I said, no, this looks like a low. It's coming back to 120, and it did go to 120, and actually I expect it to go higher. So, but the point being, if you look at the euro-US dollar cross rate, go back 10 years, and again, a lot of traders, and it's okay. They're day traders, or they're into little pops or little reversals, and that's fine. That's if that's what you do. That's
you had a 160 euro 10 years ago, Jim. And go ahead.
Yeah. Well, that was, look at the euro's gone from, I remember being in France on vacation in early 2000 when it was 80 cents. We were traveling with another family. We couldn't spend $100 on dinner. We tried with wine and dessert and everything else, but we couldn't do it. But my point being, there have been 10 moves of greater than 20% in the euro-US dollar cross rate in the last 15 years. So when you look at that, you say, well, gee, the euro is a major currency, one of the largest, 400 million people in the countries affected by the Eurozone. And of course, the US is the dominant global reserve currency. It's 60% of global reserves, 80% of global payments, almost 100% of the pricing of oil. So these are two very important stores of value. Shouldn't they be stable against each other? And the answer is they're not stable at all. So what it means is your trading opportunity comes from the fact that when you see it move towards one extreme or the other, you should expect a reversal, and that's what's been happening.
Okay, interesting, Jim. So we look at what's happening now, trade wars looming. Is this what you would call an escalation of the currency wars? And do you expect a full-blown trade war? Or are we just going to dance around it and it's just a negotiating tool?
I think we're in a full-blown trade war. So first of all, your first point, Dale, trade wars are in some ways continuations or natural sequences from currency wars, and here's why. You start out with a currency war because it's easy. It just looks like low-hanging fruit. Say, hey. By the way, the economic conditions for this throughout history have been, there are two conditions. Number one, too much debt, and number two, not enough growth. If you have enough growth, no one worries very much about the debt. And if you don't have that much debt, you can borrow to find a way to grow. But when you have too much debt to begin with and not enough growth, that's when things slow down. That's when people get more desperate. And so they look for ways to improve growth. And the easiest way is just to steal from your trading partners by devaluing the currency. And that's something you can do unilaterally. And so historically, countries have done that. The problem, of course, is that is the reaction function. So I devalue against you, and you say, well, two can play, I'll devalue against you, and you go back and forth and back and forth, and no one really gets anywhere. It's not even a zero-sum game, it's a negative-sum game. Now, there is some short-term advantage. You can get a little bit of a pop, and when we saw the euro so low a couple of years ago, it did help European growth. Well, guess what? The euro went from 105 to 120. What happened? Europe slowed down.
Right.
Europe growth looks very weak right now. So so the point being, it just goes back and forth. So that can go on for years, but then countries say, well, it's not working. We still have the debt, we still have slow growth, the currency wars are not working, and they never do. And so you go to trade wars. Again, it looks like low-hanging fruit. That's where we are right now.
Right.
And that'll go back and forth, and that's also inconclusive. And then you end up with shooting wars. World War II is a good example. And that actually is good for growth. When you actually get into something like a world war, it ends up being very good for growth. And we saw that in the 1940s. I'm not a warmonger. I'm not advocating it.
But not if it's nuclear, Jim. And I just want to ask you back to this. And, I was going to get to some geo stuff here. So I'm thinking that what you're saying right now is probably part of your new book, The New Case for Gold. So there's always been a case for gold. I mean, people that are gold bulls, they say, don't wait to buy gold and wait. What's your new case for gold?
Well, a lot of the new case is the old case, but specifically things that are new, things that were not part of the discussion in the 1970s or even in the early 2000s. Mainly have to do with geopolitics and cyber warfare. So in 2009, March 2009, I was a facilitator and a participant in the first financial war game ever conducted by the Pentagon. Of course, they've done war games forever, but this was new in the sense that all the weapons had to be non-kinetic. So you try to hurt your enemies, your adversaries with, using stocks, bonds, commodities, currencies, it's derivatives, etc., not using things that would shoot or explode. And the scenario we laid out with the Pentagon, I had some associates, we kind of, cooked up a plan just to make it interesting, would be that China and Russia would load up on gold and then would take other steps to basically derail the US dollar as the global reserve currency. We had a scenario where they put the gold in Switzerland and they start a bank in London and they issue a new currency backed by the gold, etc. it was pretty over the ridge line, over a couple of ridge lines. We didn't think it would happen soon, but we were just trying to. That's why you do these war games, to do scenario analysis for the Pentagon.
China and Russia have been doing that, and other countries also asking the Fed to ship their gold back.
Well, that's right. I mean, we were pretty much laughed at. There were some top economists and international monetary experts, and no need to mention names, but we had people from Harvard or think tanks, et cetera, and we just got laughed at. Like, why are you guys doing this? Why are you bringing gold into this? That's not why we're here. Since we did that, Russia has tripled their gold reserves. China has tripled their gold reserves that they've acknowledged, but they may have even more gold. I expect they do. Off the books in the State Administration for Foreign Exchange. So they're acting exactly the way we predicted in 2009. But having said that, with cyber warfare has also come a long way. So one of the things I like about gold is that it's physical, it's non-digital. You can't hack it, you can't erase it. I don't recommend so-called paper gold. If you want to trade GLD for a little short-term swing, I mean, that's all well and good, but if you're buying it for a permanent part of your portfolio, for insurance, for protection against some of the risks we see out there, you definitely want physical gold.
Okay, and how about the miners though? In the 30s, I believe home stake mining during the Depression, during the deflationary period, was one of the best performers. I wasn't around then. I know you weren't either. But do you think the miners, which have been underperforming bullion for quite some time, could catch a bid if we get a breakout in gold, say above 1380 or so?
Yeah, the thing with gold miners is the basic economics of the gold mining industry make them a leverage play on gold itself. So if gold breaks out to the upside, and it will. I mean, I've got it going to $10,000 an ounce, but I like to remind investors it's got to pass 2 and 3 before it gets to 10. So I've got analysis behind my number, but whether you agree or not, it's going to say it'll pass 2,000 or 3,000 or 5,000 on its way to 10. So there's a lot of upside there, and gold miners will do even better because they, once they cover their fixed costs, then everything drops to the bottom. Every dollar drops to the bottom line. You apply a multiple to that, and you can make a lot more money. The problem with gold miners is that they're not generic. And when you pick gold mining stocks, you have to be really, really careful. The economics are what I just described, but the biggest variable in gold mining stocks is management. Look, gold is gold, geology is geology, feasibility study is feasibility study, capital costs are pretty much the same across the board. Know the jockey is a good way to put it. So when I look at gold mining stocks, I look at management, the management's track record. Have they done this before? Some of these companies are great. They are great values. Some of them are frauds, and you have to sort out the good, the bad, and the ugly.
Okay, well, I know we're pressed a little bit for time here, Jim, so I was going to talk about Powell, and I read that you feel he has more tolerance, and we're really not going to have the Yellen-Bernanke put. He's going to be more tolerant to market declines. But what's happening on my TV screen, I'd like to acknowledge that you thought that Trump and the U.S. was not going to bluff, that by this spring that we might hit North Korea. Is it possible that Kim Jong-un believed what your research was telling you, and that's what started this love fest on the Korean Peninsula?
Yeah, I do. I was a pretty prominent voice last fall in September, October, in a series of interviews. Saying that I expected there would be a war by the end of March. But this is two things. Number one, this is what we call a self-negating prophecy, meaning it's a prediction that is true when you make it, but it becomes untrue because people actually believe it, and the reaction function makes it untrue. It's a little technical, but it's the other way I describe it. It's yeah, well, that's right. I agree with that. I met with a top Chinese national security advisor, someone who speaks directly to the Politburo in Washington last October, and she said that we were having lunch, and she said to me, Beijing thinks the U.S. is bluffing. I said, you go back to Beijing, tell them we're not bluffing. And I had met with Mike Pompeo, who at the time was Director of Central Intelligence, now Secretary of State, and H.R. McMaster, who was the national security advisor at the time. He's left, replaced by John
Right.
Bolton, who's even more hardline. But my
Yes.
point being, we were not bluffing. Well, that message got through, and I wasn't the only one. I mean, China,
Right.
Beijing was doing outreach to many people around the world, such as myself, too. And the message came back, we're not bluffing. So based on that, Kim Jong-un said, well, I'm either not ready for a war or I don't want one, so
Yeah.
I'll clean up my acts. So to me, it's like you're watching a 2-hour movie. Somebody hits the pause button, you go into the kitchen and make sandwiches, but it's still a 2-hour movie. You've just hit pause. So right now we're on pause. Things are good, and thank God. I agree that that's a good.
Do you think anything will come out of it?
Let's see. Let's take it one step at a time. I think that probably not. I don't think that Kim's nuclear ambitions have changed. His real ambition for Kim, nuclear weapons are a means to an end. The end is the reunification of the Korean Peninsula under his dynasty, under terms favorable to him, and getting the U.S. off the peninsula. So everything I see right now, I'll give you a concrete example. Kim announced the other day. We're going to decommission our nuclear weapon testing site and invite the world to come in to see it. Well, guess what? It collapsed. They blew up so many bombs. The mountain where they did this collapsed. He had to decommission it anyway. So that's an example of a concession that's not really a concession. Now it sounds like they're releasing U.S. hostages. That's great news for their families.
Why don't we wrap it? I know you have to go in a minute, Jim, because I could talk to you for about, I don't know, a week or so. To me, it looks like the target has been from the beginning of the Trump administration, Iran. His first trip was to Saudi Arabia. He's probably not going to recertify the nuclear deal. The enemy of my enemy is my friends. Do you think that this is going to turn into a hot war with Iran? And will oil and oil shares be a good way to spec on this geopolitical crisis?
It might turn into a hot war. It's certainly going to get uncomfortably close. By the way, Iran has been acquiring huge amounts of gold. They're non-transparent, so we don't know the exact numbers other than the amount that the U.S. flew gold into Tehran. We gave them gold as part of this JCPOA, Joint Comprehensive Plan of Action, that wasn't even signed. That we shook hands on. So they're part of what I call the axis of gold, which is Russia, China, Turkey, and Iran. Watch those 4 countries. They're all piling up a lot of gold, getting ready for confrontation with the United States. But yes, it could turn into.
Would Russia and China get involved if there was some type of conflict between Iran, Syria, Iran, Israel, Saudi Arabia, and the U.S.?
Sure, because Iran is a major customer for Russian nuclear power plants and weapons, and China is a major customer for Iranian oil. So they both have strategic interests in Iran, in addition to the ones you mentioned in Syria and Lebanon and elsewhere. So there's, whenever you're rolling the dice in the Middle East, you're talking about the potential for world war. Let's hope it doesn't come to that, but it will get uncomfortably close. By the way, one of the counterintuitive plays, people think, well, gee, if there's war in the Middle East or potential for war, that's going to restrict oil, et cetera. History shows that these countries actually pump more oil because they need the money. So I do think oil is a way to play it. Maybe in the short run you go long, but I'd watch that carefully because look at the Iran-Iraq war in the 1980s. Oil went to $6 a barrel because everyone thought they would close the Straits of Hormuz. But what they actually did, they pumped like crazy because they need money to fight the war.
Again, you prove it, Jim. You're my favorite contrarian out there, and really I really enjoyed talking to you. Thank you for your time today and coming to edify our community. And I hope this is the beginning of something we could do every quarter or so to keep informed with what you're thinking.
Thank you, Dale.
Really appreciate it. Jim Rickards, everybody, buy his books, and especially Currency Wars. It's required reading if you're a Euro Yen trader, any kind of trader, and The New Case for Gold. And you could follow Jim on Twitter at Jim Rickards. Thank you, everybody. Have a great rest of the day. See everyone for TGIF Friday. And remember, don't just count your pips, count your blessings. Good hunting. See everyone tomorrow. Thank you again, Jim Rickards.